So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statement? I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. Today, we are going to continue our Tiffany case study after the buyout, or after the announced buyout by Louis Vuitton of Tiffany, which should be completed in 2020. The buyout of Tiffany for $16 billion by Louis Vuitton. Part one, we did a full preliminary analysis of Tiffany, analyzing the company on using my checklist that I've developed over the last 12 plus years to evaluate businesses and find great investments faster. Then in video two, I explained what all the metrics and terms on that value or on that preliminary analysis checklist meant, why they're there, why they're important, what they show you, the red flags they might show you, the potential good things they might show you, all that kind of stuff. Video three, we talked about the cash conversion cycle and why it's so important. The 8 to 12 things it shows you, gives you clues to where to look for on very, very, very important information. And today we're going to talk about the enterprise value and why it's a much better metric than market cap. Okay, so market cap is here. This is simply stock price times number of shares outstanding. Doesn't include debt, doesn't include cash, which makes it very limited usage, since 99.9% of companies worldwide, public or private, have either cash or debt or both. So in my opinion, market cap by itself isn't a very useful metric. What I prefer, or one of the things I prefer, is this. And this template right here, this is one of the free gifts you can get below by signing up below. This is one of the things I sent to brand new students of the masterclass coaching program, all that kind of stuff that they automatically get for signing up. It's all the important valuation metrics, or valuations and explanations of important profitability metrics, float, investment float, all that kind of stuff. So you can get that below. It's one of the 5 free gifts you can get below for free by signing up to one of our email lists for free. You'll get this along with 4 other free gifts. Okay, so enterprise. Okay, we'll talk about this in another video. So just for now, worry about this. Copy this over to a blank page so we can concentrate just on this. And this is going to annoy me. Sorry, I have OCD when it comes to this kind of stuff. The fonts are off, I can tell, or the sizes or something. Not sure why. Not sure why this is taking forever. Okay. So, enterprise value is the estimated value of the business when considering its market cap, cash, and debt. The reason this is important and a much better metric than market cap by itself, not only because it includes cash and debt, which we already talked about, but we want to think of, when we're evaluating any stock or any investment, we want to think as if we're going to buy the entire business. Market cap doesn't allow that because, again, it doesn't include the all-important cash or debt. As deep value investors, most of us care first about balance sheet strength, and knowing cash and debt is ultra important for figuring that out. Enterprise value includes those things. So it gives a more true look at the company's total value as if we were to buy it today, the entire company. This number right here is a much truer explanation of that. And the calculation is as follows. Market cap minus cash and cash equivalents plus short and long-term debt plus preferred stock, if any, and plus minority interest, if any. So before we actually calculate it, let's go over this. Why do you subtract cash? Because as if we were to buy the whole company, we would get the cash as part of the buying the entire company. So that's why we subtract the cash. We add debt because we would have to pay that long-term and short and long-term debt. We would have to pay that as new business owners. Unless you renegotiate massively or pay off the debt with your cash reserves, you're going to have to pay that debt. That doesn't just go away because you buy a company. We want to know about the preferred stock because typically those have more rights than regular shares. So we want to know if there's any preferred stock. And minority interest is interest the company owns in subsidiary companies or investment companies. Typically, it depends on how they're kind of structured. The deals are structured. But typically this is investments in subsidiary companies and their minority interest, meaning less than 50%. They don't own majority interest in the company. Okay, let's go back here. So we need the market cap, 16 billion. I'm gonna round up. 16 minus on 12, 16, 19. Again, if you didn't see the previous videos, I make sure to note all of this so I can go back at any point in time and know what I was talking about. So I don't have to guess, for example, are these numbers here in millions or billions? Because that will make a gigantic difference in the analysis of the company. Okay, minus cash. Let's go financials. If it's all no data available, I don't know why Morningstar has recently been showing this. I'm not really sure, to be honest. I don't know if they have a problem with their data feed. So another way to do this is if they are having issues and some data isn't showing, is we can go to the key ratios tab. And go, financial. So 8.5% of their balance sheet is in cash. So we can go, we can't because their balance sheet isn't showing. Let's see if it loads again. Nope. So what we can do here is go to their website, get their most recent financial statement. Financials. Their last report was a quarterly report, if memory serves me right. Is this a press release? Okay, so we're gonna have to do some digging. Okay, cash, there's exactly what we need, $530 million. Minus 0.53 plus 974. 0.97 plus okay, so what I would do here, if a company is like this and their data feed isn't showing up, does Tiffany have any preferred stock? This is legitimately the exact way I would show you, or that I would look for it if a company's information isn't showing up on Morningstar. Okay. Okay, so they're calculating it here. So they're showing 0 preferred stock. And we can talk about this when we'll talk about total enterprise value, because this is very, very important. This is part of what I calculate. I usually do this for total enterprise or enterprise value as well. But again, without the balance sheet, we can do this. So let's we'll talk about this in a second. So preferred stock 0, 0 plus minority interest. Go back here. It's all behind a paywall. And I'm seeing no minority interest. This isn't exactly an apples to apples comparison, because above, or the link, here we go. That was an annual, so let's see the quarterly. And their quarterly is not showing up. So it must be something wrong with the data feed for all these websites, which is why it's not showing up. So I'm going to put 0, 0. Okay, so normally what I do here, is have this line in here. This line is, or is things like, let's get their annual report. We need an annual report for this. So this is part of what I do when I calculate enterprise value normally, is I include total obligations, what's called total obligations. This is the capitalized version of operating leases, unfunded pension plans, tax assets, subtract tax assets, all those kind of things. And again, we'll get to this more in the total enterprise value video, but I do want to show you this here because I do this this is how I actually do the calculation. So okay, so operating leases, inventory purchase obligations. Okay, so what I need to do is read these footnotes, see what they are. Okay, so I would include this number, not this number, because that will fluctuate, and this number. Based on the footnotes, I'd include these numbers. This number, no, because it's already included in the short-term debt. So what I would do here is I capitalize this number by 7. Why 7? Because typically these kind of leases are for things like equipment, buildings, other long-term leases like that. So typically those leases in the commercial area run 5 to 10 years, depending on the contract. So we just kind of go the middle ground of 7 there. So 292 times 8, or 0.8. 0.8 times 7. So that's 2.1 billion rounded up. Okay, so go back to the calculation. Market cap, debt plus 2.1. And I would denote these like this, so I know what they are again, so I don't have to guess. Plus inventory purchase obligations. Again, I would include those because those are necessary for their business, purchasing diamonds, stuff like that. Plus other contractual obligations down here. This is licensing and servicing contracts, fixed royalty commitments, construction in progress, and packaging supplies. So these are necessary to run the business. 0.1. So that's another point. 0.36. Okay, so the reason we add these in here, we want to know about these, is because, again, as a total business owner, we would have to pay these out right here. We would have to pay these out if we were to buy the whole company. These contracts are generally extremely hard to get out of, or if they're for things like equipment and inventory, are pretty much impossible to get out of because they are needed to run the operations of the business every day. So operating leases, yes, if they're things for like equipment or buildings, you could get out of them, but you would have to pay some kind of penalty typically to get out of them. So most of the time, people will not get out of them. They'll just wait till the contract ends and renegotiate or go somewhere else if they have to. So these are necessary to calculate for enterprise value as well. And we'll talk again more about these in depth when we do total enterprise value. So 16, 3 plus 0.97 plus 2.1. 6 equals 18.9. So what happens if enterprise value is higher than market cap, which is the case here? It's one sign that the company may be overvalued. It's a definite sign that the company has more debt and long-term obligations than it does cash, which means there's a lowered margin of safety. Is it necessarily a red flag? No. But for example, if this was 16 and this was doubled at 32, that would be a red flag because that would mean the company would have an enormous amount of debt compared to cash. What happens if this was 8.9, let's say? It's one sign the company could be massively undervalued because the company would have more cash than short-term debt, long-term debt, and other obligations. This number can also go negative, and it does go negative on a regular basis for companies like insurance companies. If that is the case and it's not an insurance company, it's a potential sign that the company is massively overvalued because the company has large stores of cash relative to the size of the company. Maybe the company is operationally not as sound, but they have a ton of cash. So they may be some kind of NCAV situation where their cash or net or short-term assets are incredibly valuable, at least on a balance sheet level, and they may be worth more than the entire market cap of the company. Again, you don't see that very often, especially with the market going straight up, but it is something to watch out for. So this is pretty straightforward. Enterprise value is pretty straightforward. This is how I calculate it anytime I look at a business. It's one sign that the company may be overvalued or undervalued or about fairly valued. In this case, it's probably about to slightly overvalued. It's a definite sign that the company has a slightly lowered margin of safety here because they have more cash and long-term obligations than their market cap, which means they have lower cash levels right there, at least, again, relative to the short-term, long-term debt, stuff like that. Other things you have to factor into this calculation are or at least think about, is the free cash flow production that the company produces. So if the company produces high free cash flow, this number may be higher because the company can support more debt. Now, as deep long-term value investors, we we would prefer not to see that, but it is something you kind of have to think about. So when it gets to this kind of stuff, it's not always as straightforward as some of the other things we've talked about. There's a little bit more art to this side of things, especially when it gets to total enterprise value, which includes even more numbers here. But this is an ultra important number. It's far better than the market cap because it shows you the real world kind of quick look at the company's assets compared to its debts that it pretty much has to pay unless it wants to go bankrupt. So gives you a quick look at balance sheet strength, margin of safety, gives you a lot more clues on areas to look at for potential red flags, potential hidden assets. If this is lower, potential red flags. If this is far higher than the market cap, those kind of things. So, and this is, again, another reason why it's on my preliminary analysis checklist, because it shows you multiple things in a very short amount of time. So that checklist, again, which you can download for free along with the valuation and analysis templates I just showed you that are usually exclusive to only students. You can get that at the link below, just by signing up to our free email list. And these two things combined with the other 3 gifts that you'll get for free in that free mail sign up will allow you to become a much better value investor faster, and will help you evaluate companies a lot faster, which will help you earn higher returns on a more regular basis. So I hope this helped. In the next video, we are going to talk about, what are we going to talk about? We were going to do a conclusion piece, but instead of that, I'm going to do a quick little tutorial on total enterprise value. No, let's save that. So we'll do a quick conclusion, and then we'll do move on to the next case study going into next year. I'm recording this a couple weeks before Christmas, so trying to wrap things up before Christmas break, because I know a lot of you are going to be traveling or spending time with family and having time off. So I don't want to do a bunch of too much stuff while everybody's on break, so you don't miss it. So I hope you enjoyed this. If you have any questions, comments, concerns, let me know in below. If you are watching on YouTube, make sure to like, love, share, subscribe, and hit the notification bell so you're notified anytime we release a new video. And we're releasing new videos all the time. If you're listening to this on a podcast, make sure to, again, like, love, share, subscribe, because we're releasing new podcast episodes all the time. In the meantime, thanks for watching. I hope you learned a lot. I hope you use this in your analysis. And I will link the free gifts below, and I'll also link some resources about how you can EV to EBIT, and those kind of metrics are far better than PE ratio, and why I never use the PE ratio. That's important as well to understand why I never use net income, why I never use the PE ratio. So I'll link those below as well. Until next time, thanks for watching. Have a great day. Talk soon. Bye.